Ed, consumers are still paying top dollar for premium wine, and this is despite a pretty tough economic environment. We all need better wine in our lives at a time like this, so it makes sense.
Look, we sure do, Laura, and that's what Treasury Wine Estates have seen over the last 12 months. It's a little bit surprising. Penfolds, obviously their big premium wine brand, sales there have gone up pretty sharply over the last 12 months, but there are other smaller brands like Lindemans, Wolf Blass, things like that have decreased. You can see here group sales were about $2.4 billion, down slightly, but the revenue from Penfolds up 14% to almost $820 million. Their net profit did go down very slightly. And the dividend, though, that was lifted by 1 cent. So Treasury Wines are seeing consumers being more choosy with what they want to buy. They're going for the premium brands like Penfolds over their other massive list of wines that they have in their portfolio. So this is just a sign that consumers are still spending money, but they're just being picky about what they want to spend it on. So Penfolds obviously a really big business for Treasury Wine Estates, and it's helped them boost their profit margin during the year, which was a tough year because they did see consumer discretionary spending drop off for virtually all of the other brands that they have in their portfolio.
Yep, they've now got a perfect Chardonnay, by the way. Yatana, 2021.
Beautiful.
Recommend. Haven't had it, but will. Ed, later this morning, June quarter, the June quarter wage price index, I should say. So wages are expected to grow 3.7% during the year.
Yeah, that's the prediction here from Bloomberg's economist survey. 3.7% growth rate for annual growth rate for wages, 0.9% growth for the 3 months in the June quarter. So 3.7% sounds pretty good, but remember inflation over the 12 months to the June quarter was 6%. So wages growth is not keeping up with inflation. And that's obviously something, Laura, that we've seen for the last 2.5 to 3 years now. Wages growth has been a lot lower, and it's going to eventually overtake inflation. It might be by the end of this year we'll see wages growth and inflation at the same level, but right now it's still tracking underneath where inflation is at in our economy. So those numbers come out at 11:30, and at 11:30 we also get the board minutes from the recent Reserve Bank board meeting where they surprised quite a few economists by keeping rates on hold. So could get some good commentary out of the RBA today as well.
Yeah, okay, so where's it all headed? When we look at the data this week, are we still having economists predict another rate rise this year?
Right now, the consensus from most economists is rates are at their limit at 4.1%. We also will get the unemployment numbers coming out on Thursday, which should give economists and the Reserve Bank a bit more info before the next RBA board meeting in a few weeks in September. But right now, the general view is 4.1% is the limit. The thing economists are now talking about is how long the cash rate is going to stay at this level before it starts to drop. And the predictions at the moment are it could be 12 months or potentially slightly longer before the Reserve Bank feels the need to start cutting interest rates. There are still a few economists, though, that believe we could see one more rate rise for Australia's economy, but they are the outliers. Most of them say 4.1 is the limit. So I guess that's a bit of a silver lining, but the bad news is rates are going to stay at this elevated level probably for 12 months, perhaps a little bit longer before the RBA feels the need to begin reducing the cash rate in Australia.